We are going to be talking about some valuation issues today, and this is going to be one of those things where have you been in a situation, especially if you're in a large company, a global company, multi-operational company, where you have subsidiaries or related companies that are buying and selling to each other and whatnot. This is going to be one of those where have you ever been challenged on what the valuation should be when it comes in? Obviously, you're going to be looking at trying to do, avoid as much in duty and taxes and whatnot. So we're going to get into that kind of discussion. Lalo, this is going to be one of those where, especially for related party type situations, if you've got partners that are business partners or management that are partners in other companies and things of that nature, this is going to be an interesting discussion, I think.
Well, it is because especially these days when you're trying to mitigate tariffs and any reciprocal tariffs, EPA tariff, anything having to do coming in, you're trying to find ways that you can mitigate those through other avenues. One of them is very popular, which is valuation. So on the show, we have a somewhat of a business partner for Global Training Center because Renee Cucurelli, which you all know, works for Global Training Center and does hosts her own episodes here on the podcast as well. She helps KBKG, and we have Alex Martin from that firm. Alex was telling us before we hit record, Andy, he was telling us that he didn't quite intend on being in trade with his practice. And I almost want to say, welcome to the club. Nobody really intended to be in trade, right? We kind of all accidentally fell into it.
Welcome, Alex.
Andy and Lalo, thanks so much for inviting me. And trade has always been a important part of my career in the transfer pricing area. And in fact, I've actually did some international trade consulting a while back before becoming a transfer pricing specialist. And it all fits together, but unfortunately not everything necessarily works smoothly when it comes to multinational companies handling transfer pricing and customs issues.
From somebody that has been in the corporate life, even in, with a transportation company, there was still, I worked for FedEx, but I've worked for several companies too. But that's one of those things, a lot of things people look at it, well, it's a carrier, so they ought to know all this. You still have your corporation. They're buying uniforms of fuel. They're buying parts. They're buying all kinds of things. And a lot of times there are partnerships that are done in other countries. And so it's a related company of some kind and all of that. So even when you're buying from a source directly from, a non-related party, then you have a related party type thing. And then you've got things where you're trying to help out, other operations in other countries, and they're trying to shift over. Hey, we're out of uniforms. Oh, we've got some over here. We'll shift them over. All of that comes into play where, okay, you're a related company. What's the value that we should be, using here and whatnot? It's okay to make a profit so you can bring it in wholesale and then you raise your thing. Or sometimes it's not okay to undercut your price as a source and then bring it in. We're trying to minimize that the cost because it's a related situation, because you can bring it in below market price and then customs is going to have an issue with that. So you're undervaluing. So it's one of those things where there are people involved, generally speaking, that are on this valuation that may not necessarily reach out to the import-export compliance folks. They make their decision on it, and then they get themselves into trouble, I guess is like, so I'm teeing that up.
No,
Alex said, so yeah, that's almost like a nice little softball on a tee stand there for you.
No, it's absolutely perfect. And transfer pricing is all about making sure multinational companies pay the correct amount of income tax by country. So, for example, if I have a German parent company that has a U.S. subsidiary, if the German parent is selling auto parts from Germany to the U.S., well, if they charge too high a price to their U.S. subsidiary, the IRS is unhappy. Why? Well, they're not getting their fair share of tax in the U.S. Conversely, if we have the German company charging too low a price on inventory going into the US, the German tax authority is having heartburn because they're not getting their fair share of tax from these multinational companies. Now, replicate that for 100 countries worldwide, and you've really got the most contentious income tax issue for multinational companies worldwide. Doesn't matter if you're the FedEx, the Apples, the Coca-Colas of the world, or if you're a mid-sized company just trying to set up shop in the US, there's a transfer pricing issue in play when it comes to related companies on a cross-border basis. And while we largely focus on inventory transfers here, there are royalties and service charges and other transactions that are also important from transfer pricing and also can be considered dutiable charges from a customs perspective. We got a lot of companies, and every other phone call I have right now involves transfer pricing and customs duty. So that is why, a discussion here and a bridge in the gap is especially important for when working with multinational companies.
All right. So with what you're saying, folks, this is something where this is going to be a show that you probably need to reach out. If you're in the compliance arena, or if you're even a head of a company, you need to probably reach out to your finance folks, to your CFO and their organization, with your accounting, with both your accounts payable and accounts receivable, because part of that scenario there, and then your sourcing and all of this, it comes into play from a standpoint of in the finance side, is also your tax accounting. Because when you start looking at this, here's the application of what we're going to be talking about: it is legal and valid to do what you would call a tax avoidance. What do we need to do to avoid paying as much, any taxes, all that? What's not good is to circumvent the tax payment on certain things. So people will get into undervalue and overvalue and all that. So you need to plan this out more than just the duties and taxes that you may pay on an import. It's like you've got to also look at it after you've cleared it and what you're doing. So Alex, you're talking about it from a standpoint of, from the income tax type thing is on a transfer. You're looking at something here where you're moving it from one company to another and then turn around and selling that product versus moving it from one company to another to be used within that company.
Well, actually, let's say we've got a manufacturer in the US that's buying from a related company in China. There's a transfer pricing issue in play because, well, that customs duty on that product that's coming across, that impacts both how much duty you pay and how much income tax you pay. The issue that really causes heartburn for a lot of companies is that you can be whipsawed. So basically, customs comes in and says, actually, we think you should be charging 25% more because we want more duty. Conversely, you've got the IRS looking at the same company and saying, hey, we think you're underpaying your income tax. We want to see a lower cost of goods sold. So that causes some heartburn when you're juggling the dilemma of managing transfer pricing. To be frank, a lot of the finance people, customs really wasn't top of the agenda because, well, tariffs used to be, on average 2 to 3%. I'm not telling you anything new, but now we're 25, 50%, what have you. It's an additional cost to the supply chain, but they don't have a handle on how it all applies, and that certainly has been topic number one, certainly over the last 9 months here.
Well, with what you're talking about is, one of the things I was talking about in the transaction is reactive of who's involved with this and all. Another party in this, again, it comes back into, there would probably be both finance and marketing of a company, and that's the pricing group.
Absolutely.
Pricing is going to look at it and making that assessment. So, Alex, one of the things that I'm hearing is evaluate what the valuation should be for, these transfer pricings on an international transaction is you need a multi-organizational team, I guess, to really look at this, assess the situation, and walk through this. So we can talk through this in a minute, but who should lead that kind of, assemble that team, and who should walk through that?
Depending on the size of the company, it may be the chief financial officer, or if there's a tax director who also has a role with respect to customs or tariffs issues as well. Part of the reason is that they are facing some surprises on having this very large increase in the price of goods. So to me, I found the most successful way to organize things is have the chief financial officer involved or tax director for no other reason than they have to manage taxes on multiple locations, and they need to understand, well, how does customs fit into the overall tax burden for the company?
Well, and you're hitting on something again where I guess when you're talking about, income tax of against a company, I guess, or assessed on a company, generally speaking, that is not something that though the tax accounting department would reach out to the import-export compliance group, the transportation group, the sourcing group. I mean, traditionally, you would not have that discussion, and they may not even realize they need to, I guess, in this deal. Right?
Exactly. And actually that extends to the CPAs too. The CPAs are real focused on income tax compliance, and they've never thought about customs duties. For most of the companies that we come across, this is all disrupting a lot of tax planning. And so getting people to talk is really the first step for managing this dilemma.
I see this as dropping a rock into a really pristine pond or lake, right? You have this really glass-looking body of water, and you throw a rock out there, and what happens? You see the ripple effect.
Yeah.
I see this as a secondary ripple effect of the tariff situation where people are assessing that and they're getting, it's like you had your operations, you got everything going. I had somebody on that was saying that in $1 million worth of imports on goods, they had paid like, $16,000 in a year. Now they're paying $600,000 on that same $1 million. So it's like, whoa, man, not only did their situation get disrupted as far as the imports, but I mean, significantly hit on the cash flows and all that. All right. Now we have a secondary deal here where you're talking about the income tax regarding here in the U.S. with the IRS or with the, offshore country of your related company. So I guess in looking at this now, coming full circle, if an import and export type group is involved and they're listening to this going, I don't think this is going to be involved with me or whatever. Yeah, you better be careful. Do you have a recommendation on how to get the attention of that finance group?
Sure. In general, the IRS is going to, if we've got a foreign owned company that is importing into the U.S., that $600,000 additional duty is going to reduce the amount of income tax paid or even generate losses. Well, from an IRS transfer pricing perspective, their go-to argument is that the parent company should bear the risk of those customs duty. So in other words, transfer prices of products should be reduced. And that's going to be a big surprise for a lot of companies because it's a new explosion that's really disrupting how much tax you pay by countries. We're trying to juggle that with a good significant portion of our clients because they're not quite sure where the loss from tariffs should end up. And
well, to your point, I mean, what I see is to deal with the significant increase in tariffs, you have two things that are going to happen more than likely of what I'm hearing. One, there is going to be a price increase for the product. but it may not cover the whole deal with the tariff. So in other words, you have two things. One, an increase in the price of the product and an absorption, if you will, of the tariffs, which actually then lowers your margin. So regardless of what the IRS wants, if your margins now are reduced, your income tax, if you will, liability is going to be reduced. So then the issue here is to what you're saying is, I guess, IRS, and the CPAs that are filing the income tax returns and all of that in the different countries, you're going to be looking at it with a reduced margins. That's just another side effect here is that income taxes will be the revenue to the company, to the country would be reduced because your profit margins have reduced.
Exactly. And when you come across an audit, let's say for 2025, the IRS auditors may say, well, I don't know much about your company, but I do know how much tax you paid. While that may sound obvious, that's a really powerful insight for understanding how to mitigate that risk from those customs for those tariffs. So that's a rule of thumb that we use with companies regardless, customs issues or not. It just makes things quite a bit worse now that we're dealing with this really massive increase in inventory costs.
So how does that surface when you're talking about this? I mean, right now don't see this as a front burner item. The front burner item is the volatility of how quickly these tariff deals are being made and how quickly the implementations are of increased duties on imported goods from other countries here as far as the U.S. goes. And then the retaliation or the reciprocal and all this going back and up and down and up and down. I mean, it may go up way high and then all of a sudden it comes down a little bit and they're dealing with that.
Yeah.
And then, so how does this come into play where I guess we're at a point where the fiscal years, if you're using a calendar year, is seeing the biggest impact on the income tax returns coming in? I guess it would be January or February that this may surface regarding internal to companies. Are you seeing, IRS or tax authorities that are approaching companies to say their quarterly filings are off or something like that, or what? What are you seeing?
Well, as you said, the tax returns won't be filed until March, April, maybe even as late as October. And the IRS doesn't necessarily audit until those tax returns are filed. What I use as a best practice here, though, is to look at year-to-date income statements for the U.S. company, because that's going to be a good indicator of if the customs duty is going to knock us into a loss. And maybe we can explain that loss for 1 year, maybe two. But realistically, the longer we have losses due to tariff issues, that raises the IRS audit risk for the company, regardless for any multinational company.
So you're looking at it as at this point that this is more of a preliminary type of thought process that executives of companies, especially the CFOs, need to be looking at to analyze what the impact of the tariffs are on the margins, if you will, of the company, right?
And this is one of several areas where transfer pricing for income tax purposes is different from how customs looks at things. Customs looks at things more on by comparison, more of on a transaction by transaction basis. Transfer pricing is generally more focused on the annual operating results. So there's a disconnect there with respect to, hey, I've justified everything from a transfer pricing perspective, but customs is going to look at the same documents, say, hey, that's helpful, but it doesn't satisfy what we want to see from a valuation perspective.
So to that extent, again, what would you say would be the action that somebody needs to take to get ahead of this? Because what we're talking about here is a very key issue, I would say, especially from the CFO rankings. Again, that income tax, the tax filings, both in the U.S., your subsidiaries or your related companies. Maybe it's a parent company. The U.S. is a subsidiary, and you got a foreign parent company. Regardless of getting this pulled together, what would you recommend that somebody do that's listening to this? Normally, our audience generally is going to be more import-export compliance or import-export transportation and logistics.
We're fortunate to work with Renee and others at your team on making sure we can coordinate the custom side of things with the income tax side of things. Venture pricing's more focused on the high-level income statements as a starting point. So to the extent you can bring in both not just the U.S. management, but the international management and say, hey, look, here's our income statement, but here's how much worse it is because we've got to pay tariffs. Well, that at least gets people to think about, well, A, can we lower our transfer price? B, are there other charges, let's say royalties, other transactions that might be dutiable under customs audit, but they hadn't really thought about it that way. And third, bringing up things like foreign trade zones, bonded warehouses for those companies that export duty drawback. A lot of the companies that we work with are not aware of those special customs programs can at least mitigate some of the cost of duties.
Well, and to your point, though, is that the foreign trade zones and things of that nature, like you said, bonded warehouses. All right, a foreign trade zone, yeah, you're going to take goods, you're putting them into a foreign, if you will. It's on U.S. soil in this case, but it's physically right there. But then, you're still going to clear some of those goods generally into the U.S. commerce.
Yep.
And then other product of that in that same warehouse will go directly out to foreign countries, if you will, other countries for the sale. That's fine, but you still have the scenario here where then the original source is, selling to the U.S. It's held in limbo, and then it goes back out. So again, out of all this, your valuation scenario here, when I'm hearing, Alex, as far as this particular issue, I mean, to start off the discussion is going to take a high level, which is, again, some of the people involved in this that are dealing with the import-export of tariffs. And you got to, here's the one thing. U.S. tariffs are getting, assessed really high on a lot of countries. Well, they are then retaliating. So you have the import-export compliance group of other countries of these companies involved. So generally speaking, again, they're not involved in the discussions when it comes to the income tax. So this is going to be something where getting outside the box, those CFOs and that, the tax accounting folks need to reach out and, I guess, develop and pull some of these compliance folks in so you can have that discussion. Let's walk through the valuation here at the high level, but then secondarily to that, you're talking about, well, should we lower or raise the transfer price? Can we, should we, whatever. In that discussion, you're going to have to get it down to the specific product involved.
Yeah, and you're exactly right. And one strategy that we have found some success with is that we find that some companies they ship something over for $1,000 and that's what they've always done for the last 10, that's been their transfer pricing policy for the last 10 years. And it's worked well from an IRS perspective since they weren't paying much in the way of duties. It really wasn't causing heartburn there. What we find is that some companies, if they split off or bifurcate some cost and make them service charges, so your management fees, your admin fees, those costs that help run, let's say, a U.S. subsidiary, well, those costs aren't going to be dutiable. We got to make sure that We got to make sure of that. But it really does. Our thought process is that every $100 of cost that you can move from inventory price to service fees is at a 25% rate, $25 savings. Now, it doesn't save everything, of course, but it's at least mitigating some of the damage, but it does require some forethought when it comes to service fees or trying to do certain separate charges that maybe they haven't done before.
Well, I think what you're hitting on now is where if you will, the rubber meets the road, is that from the tax accounting side, again, the CFO side, as well as now, we're definitely direct application of the import-export compliance is going to be the actual valuation of a product. So you have to go through, and it's one thing of what's the cost of goods, what are the transportation costs, what is the warehousing cost, what's the administrative cost. You start building that whole thing up, and you get your pricing involved as well because of the retail. So then the difference there, are you selling the product now, even if it's a related company as far as the source or a non-related, doesn't matter. In this case of what you're telling me is that you've got to get these people to the table, and especially the import-export compliance. Folks, you need to be looking at it and say, should you be looking at the pricing, all these different valuation methodologies? That right there in today's environment may be very apropos. You're going to have a team to literally of some people to go through and start assessing that. Do you not?
Absolutely. And that may also include having foreign parent companies being involved in the process too, because they're setting the pricing to those U.S. companies. So it's not just working on the local U.S. companies, but bringing those international colleagues too, because they're going to be certainly less aware of how tariffs work, what kind of charges are dutiable versus not. The other thing that is really helpful that I found is bringing in that CPA. Maybe the CPA doesn't know much about customs duties, but at least they can provide some guidance on how the tariffs are going to affect the books here. And a large part of our business at KBKG is partnering with CPA firms to be their transfer pricing advisor, and then bringing in some great customs consulting folks, because again, they're going to be adding those ideas that's really just missing. They just don't know. Not just the U.S. company, but the foreign overseas company really need to be on the same page here, because as you know, customs is going to be more suspicious of cross-border transactions between related companies than what they might be if you're just buying from an independent company.
Alex, we're going to need to, I think we've just barely scratched the surface on this as we're getting into it. But from what I guess the takeaways of what I'm hearing from what you're promoting here is that definitely at the high level, CFO level, there needs to be some thought of bringing in your import-export compliance, your tax accounting folks, your accounts, receivable and payable, and all those things as it comes into play, and your pricing, obviously, regarding the impact of the tariffs on your margins and considering what that does to the U.S. tax filing as well as your foreign company filings. That's at a high level.
Exactly. And those companies really do appreciate when you can identify those savings opportunities on the custom side. So we're always grateful because there's such a great trade community that we're getting to know, and our clients and the CPAs are really grateful for that kind of guidance that they've never heard of before.
Well, and simultaneous to that, if you start that down the road, if you will, at the higher levels, and just start talking through that, this is something that to get this going, it's going to take quite a bit of time and quite a bit of follow-up with the senior levels. At the same time, though, I think I would initiate if I were in a compliance area, to start zeroing in on some specific products to do that evaluation and pick the methodology to say, what do we need to do, and start pulling together. We used to call for process improvement quality action teams, or a quad. There's different ones that are, well, you'd pull together a quad of people in different organizations to say, we need to look at this. You've got 2 weeks, you got 30 days, whatever it is, to come up and list the cost associated with this particular product in these different avenues. And you just start. You may not know where to start from, but you got to at least start. At some point, the senior levels, especially in the tax accounting, are going to say, where's this coming from? What do we need to do? What's the impact? And you say, well, good. I'm glad you got it. Here's some detailed information on this particular product, and here's what the impact is of the tariffs.
And I think one other thing that would be particularly helpful for the trade community is to ask for something called transfer pricing documentation. And these are reports that are prepared to justify the transfer pricing from both a U.S. and international perspective. And that's going to give, when we're talking with trade consultants or customs consultants, that's going to give you a good handle on at least how the company thinks about their intercompany transactions from an income tax perspective. And then you're not starting from scratch. You're bringing your customs expertise to the table. To me, that 30,000 foot view, 10,000 meter view is really going to differentiate when you're trying to get your arms around the customs issues. So you're not starting from scratch as trying to understand what the income tax people are doing.
Folks, I will say that as if you don't have enough to do and have on your plate, this is one of those where, okay, everybody seems to be dealing with the urgent, which has been the tariffs have been coming in, the elimination of the de minimis, and now you've got a business model that's on e-commerce that may be negatively affected there. You got to try and pivot and do some things. And what are you doing? Maybe changing sources of products from one country to another, all these other things. And now all of a sudden, we're talking about the potential impact of income tax filings for your company that you normally don't get involved with. So saying all that, I would say that you need to look at this. This is something that would be important. Urgent, I understand, but this is also important. So it's one of those, you just got to manage the whole thing and prioritize and get something going, right?
I'm 100% a big fan of being practical in these situations. Yes, we've got tariffs to address, and certainly a lot of our clients are really just getting around to understanding how the tax impacts on how customs duties apply. But if you can ask the question, hey, we'd like to understand how the transfer pricing for income tax purposes works within this, you're going to be far better positioned than 90% of the companies out there.
Well, Alex, I appreciate your comments. This is a good discussion. I feel like this is one of those where we probably need to do a follow-up at some point to get into a little bit more detail of literally who would be involved in a committee and the impact of this on the company.
Yeah, and look, when we're a big fan of educating here too. So I've got some YouTube videos on just how does transfer pricing work in terms of identifying, assessing, and discussing transfer pricing from a practical perspective. I touch on the tariff side as well, but that may give you a real clear understanding of what tax auditors are thinking about and how that addresses or brings in the custom side too. So to the extent that may be of interest. We also have some good stories about Coca-Cola and Starbucks transfer pricing issues. So I'll save that for another day.
Awesome.
Well, folks, like us, share us. We appreciate your support. Our listenership is definitely expanding around the world as well as here in the U.S. So thank you so much for supporting the Simply Trade podcast. Alex, thank you so much for being on the show. We're going to have your contact information on our show notes. So if people have further questions on this, it's like, man, I don't know where to go, but at least somebody will reach out and say, hey, I've got a question, and you go from there.
We'd rather have you call than not call.
There you go.
So we play well with others, and we're grateful to know that you all are out here as a resource as well. So, yeah.
Well, thank you so much, folks. Lalo, do you have anything else to add before we sign off?
No, just a quick shameless plug. Like Alex said, he has some YouTube videos. What I'll do is that I'll go ahead and put those in the show notes. But again, a shameless plug. Andy, you were talking about valuation earlier. We do have a short 30, 45-minute recorded e-learning class on the valuation methods, which are the six valuation methods.
I took that too. It was excellent.
Yeah. that apply to customs valuation. In this case, we're not talking about how to value your company or anything like that. We're talking about customs valuation, and so you feel free to check the show notes for that as well. And good overview for CFOs, financial people who may not necessarily like think and feel and work and trade every single day, but would like to have or need to have that understanding to support their trade folks within the company. So anyway, that was just it. Like I said, my little shameless plugs.
Well, not a problem. And folks, this is one that you need to send a link to this show to your finance folks, your tax accounting, your CFO and all that. And just, hey, please listen to this. This is something that gives some consideration to of the impact of the tariffs on our income tax returns. And it may be something they hadn't really thought about. So with that, everybody have a great day.
You too. Thank you, sir.
Thank you.
All right. Bye.